Welcome to the Techno Fundamental Report for November the 20th. Only when the tide goes out do you see or do you discover who's been swimming naked. Warren Buffett. You don't want to swim against the tides. If the market is in a downtrend, you have to remember that there's about a 75% chance you're going to lose money in the market. However, when it's in an uptrend, there's about a 75% chance you're going to make money. So right now we're starting to see somewhat of a downtrend in the market, and so we would continue to be cautious. Now, this study I revealed last week, and I've just been thinking about it all week, and I'm going, this is really, really amazing. What this basically says is that all the shareholder wealth that was generated between 1926 and 2022 was based on 3.44% of the companies since 1926. So you have to look at the situation and say, okay, what were the characteristics of those 3%? Well, I can tell you pretty much, I think it had to do with growth stocks. You had to be in growth stocks. I'm talking Walmart, Microsoft, Home Depot, McDonald's, Cisco Systems, Amazon, Tesla, Apple. And the other thing that is apparent to me about these stocks is that their products or their services tended to be available to the masses. For example, Apple, everybody has an iPhone. But this kind of corresponds with this J.P. Morgan study that I first learned about in this book called The Psychology of Money. And it basically was a 3,000 stock study that went from 1980 to 2014. And it was really amazing that 40% of the components of the study lost 70% of their value and never recovered over this period. So it says effectively all of the index's overall returns came from 7% of component companies that outperformed by at least 2 standard deviations. So it's really interesting to me that a very small number of companies, like our database is about 8,000 companies. So just roughly 3% would be 240 companies that we should be focusing on. So our whole goal is to identify that 3.44% or that 7% from this study. So it's basically saying you've got to be focused, you got to find the winners. So let's just see what's going on with the market right now. Now, like I mentioned earlier, you don't want to swim against the tides. And so when the tides are going out, you need to be defensive. And so this particular indicator is where we take the 25-day moving average and the 50-day moving average. If you break below the lower moving average and the lower moving average turns down, that is a negative signal. So at the NASDAQ, we're still holding up somewhat, but let's look at a little bit under the hood here. Here's the S&P 400, which is the mid-cap stocks. Below the both moving average, lower moving average is turning down. If we look at the New York Stock Exchange, you could pretty much say, we're getting somewhat of a death cross here, and we're getting a downturn, and we're below the lower moving averages. So if we looked at the small cap stocks, you can definitely see the moving averages are turning down, and you're below the moving averages. Now, the S&P 500, just like the NASDAQ, the large cap stocks are holding up better than everything else. It's, the Mag 7, basically. So what I'm saying, out of these 5 indexes, 3 of them have definitely sell signals where 2 of them are holding up. It would just tell us to be cautious. Now let's take another look at another way to evaluate this. What I have here is the 21-day moving average and the 50-day moving average. So we have been in what we call, since April the 7th of 25, we have been in what you call a power trend. The power trend will end if the 21-day crosses below the 50. And you can see that that's generally what's close to happening. So if you look at, that's the NASDAQ. If you look at the S&P, same thing. We're getting that downturn in that 21-day. So the power trend is in question. If we look at the new lows, the new highs minus new lows, we're kind of getting a record number here, the lowest reading we've gotten in quite a while. So there's not a lot of new highs right now, and there's a lot of new lows. So this is a difficult market, and you should handle it that way. Now, on the aggression index, last week I talked about how it looked kind of extended. Well, we've gotten a pullback like I pretty much anticipated. We broke down below the upper moving average. We broke below the lower moving average. We're getting somewhat of a bounce today. But what we're doing here is we're comparing the NASDAQ to the consumer staples, and the indicator has kind of reversed trend, has gone into what I would call a short-term downtrend, which is telling me again, we need to be cautious. Interest rates, no problem. In fact, I think they're almost dropping too much. Over the last 125 trading days, the 5-year Treasury yield has dropped by almost 10%. That's quite a lot. So it looks like interest rates are dropping, which could be an indication of economic slowdown. There's just no loan demand is what it boils down to. New lows, we're getting way up there with 170 new lows on the most recent data. We've been getting several days of this. Again, this is just a sign that the sellers are pretty much in control right now, and we're getting a lot of new lows, which is not a positive. Now, I also just wanted to mention Bitcoin. This is the IBIT, which is the Bitcoin Beneficial Interest Trust. And you can see here it's making new lows. And not that I'm interested in Bitcoin, but I do think there's a possible correlation here with aggressive stocks, risk on, risk off. This would be an indication of risk off. Now, the Chinese stocks, they're kind of in a downtrend as well. This is the Crane Shares ETF, basically showing the Chinese stocks have gone into a downtrend. So I would continue to avoid that group. So if you have any questions, please let me know. Thank you very much.